back. You're watching The Money Show on ET Now. Well, as we've been talking about on ET Now, on The Money Show as well occasionally, if there's one investment style that's really worked, it's been the growth style. More and more money is being pumped into the big heavyweights like, your Reliance Industries or HDFC Bank, etc. Value investing as a theme for the last 3-4 years has been a little low. But guess what? This is a fund that has actually performed better than some of the biggest nifty companies as well, and it is also in the value investing theme or strategy. I'm talking about the ICICI Prudential Value Discovery Fund. In the last 1 year, this fund has managed to return about a 40% return. The first in its number one in its category of funds, better than all the other value funds out there, and it's also managed to beat the index in the last 5 years, in the last 10 years, because at the end of the day, of course, value investing has to be done for the long term itself. So let's now welcome on board Chintan Haria, Head of Products and Strategy for ICICI Prudential AMC, to talk about what the secret sauce is then behind the ICICI Pru Value Discovery Fund. Chintan, it's lovely to have you back with us on The Money Show and on ET Now. Thanks so much for your time. To start with, Chintan, let's first talk about the fund, and then we can talk about, the broader theme of value investing. Like I asked, what is the secret sauce? A 40% return. It's actually managed to beat the returns of even some of the nifty 50 companies out there in the last 1 year.
Good evening, Mubina. Essentially, the secret sauce is actually not a secret sauce. It's about sticking to the processes which we've put in place in this fund for the last 15 years. So value investing as a style, as we know, works in the long run. It is like a test match in cricketing terms. It's not a T20. And like we've seen in the last 3 months or so, test matches have become very interesting and people have flocked to it. Similarly, value investing style has also worked. The key over here, of course, is patience. The longer you stick to this style, and that's where if you look at from an assets under management perspective also, we've seen in the last 10 years or so, the AUM growing from almost 1,500 crores to about 18,000 crores today. It is the largest in the category. The one reason I would say is investors have been patiently sitting and they've got the good experience. Now, the secret sauce, if it may be, is simply turning the ship before we basically see any ice, so to say, or trying to keep ourselves in terms of focusing on bottom-up stock picking. We are not too cognizant of what the benchmark is. We are not too cognizant of what the market is doing or where the returns in the market are coming. Like you mentioned, there were a few stocks, like in the last 3 years or so, the top 10 names have contributed almost a positive 80% returns, while the rest of the market have been negative. So 1 year back, if someone looked at this fund, it would have looked probably an average performer. But that did not move us from a process of actually picking the stocks where there is value, where there is inherent growth over the long term, and where the investors will obviously get better risk-adjusted returns. So that's the focus which has always been kept. If you look at the top 10 holdings, they are very different from what you would find in a normal fund. And hence, we firmly believe that value investing or value as a category should be almost 20-25% of every investor's portfolio. And they can patiently sit over it and get the advantage of that style working in the long run.
Okay, makes sense. But you spoke about how you look for value, as the name suggests, in the market. Which are those mispriced stocks where there is opportunity, but there's not much in terms of pricing. Chintan, sometimes isn't there a risk as well in that, because you have there is also that off chance that there may be a rotten apple somewhere amidst that basket of bright red apples. So how do you sort of counter that risk? What are the filters you put in place for that?
So the rotten apple, more synonymous in our industry, is considered as value traps, right? So how do one differentiate between what is value and value trap? And that's where the fund management experience and the expertise of the analyst comes in very, very handy. You need to know which business has a sustainable long-term edge and which is today going through maybe a downturn because of cyclical nature or generally markets looking the other way around. Now, back in 2008, 9, 10, if you look at this fund, it was heavyweight in FMCG, and IT and pharma. If the top holdings were pharma followed by FMCG, it sounds very, very odd now today to anyone who was looking at it. But that time in 2008, 9, 10, the big alpha came because the fund took a position away from infra stocks, away from power stocks, which were hot at that time. So whatever is hot, expensive, or is probably in vogue at the point of time, trying to see something different, trying to see where there is value and good quality is very important. And how do we stay away from value traps? Now, of course, out of the 40 stocks that we look because of various reasons like, something changing in the industry, there may be one or two stocks which we'll have to probably wait longer. But in general, the easiest way to avoid value traps is to have a strong focus on the management, the balance sheet itself, and the sectors in which the fund invests. And I think that's where, for the last 15 years, we've got it right in terms of ensuring that we do not have too many value traps in the portfolio. In fact, we've stayed away from most of them in the last 15 years because of our strong focus and process on the balance sheet side of stocks.
So basically, what we call as alpha maybe delivered by the fund manager does not necessarily come in the form of only returns, but also in the form of the fund manager's own astuteness and experience at stock picking, which is a large part of the entire value investing theme. So let's talk about this value investing theme then, Chintan. What sort of promise do you see over there, given the fact that for the last few years, it's always been about growth?
Yeah, so last 6-7 years have been very unique where because of global interest rates coming to 0% virtually and $17 trillion of bonds being in 0%, I think FI investing has been very clear in wherever there is free cash flow yield, we'll go and buy those stocks. And in India, obviously, everyone wants to play the consumer theme because India having 130 crore people, consumers will always probably, or the consumer theme will always be strong. And that's where they've been priced to, significant highs in terms of PEs. So from a overall construct perspective, last 5-6 years has seen a different kind of market. But I believe now, post the COVID event, we are going to see a different world wherein because of dollar depreciation, there is going to be an emerging market, commodity-led rally, wherein, if you are differentially positioned in terms of the various other parts of the market away from FMCG or the expensive names or the large cap, mega cap or the top 10 names, there is alpha to be created. So last 3 years were different. Last 5-6 years were different in that sense from a investing perspective. Next 3 years hold good promise. And the thing about value investing is that when the returns come, they come in a heap in terms of the outperformance versus peer group and benchmark. And the advantage that you get in value investing is that you will probably lose less over a long period of time. And hence, from a risk-adjusted return perspective, because you have stocks which are not valued very expensively, you end up making the benefit. I'd also like to point out one thing which was related to the previous question. A cheap company, because it has 4P, does not make it a value. So value is not in terms of what is cheap in terms of optical P. You need to go behind the numbers. You need to see whether a particular company, for example, let's take a metal stocks as we speak right now. They may have been, not reporting good numbers because in the past they were seeing pressure in terms of the prices. Today, if you see metal prices have gone up, so they'll see the benefit of that earning flowing into numbers. So you need to be a bit early in terms of investing in those companies where the earnings are going to come or where there is a price value gap. And that's how you not only generate alpha for the investors, you also avoid value traps. So keen focus on everything apart, not just the reported numbers, but what does the overall construct of the industry is very important when it comes to value investing. And I think it's a theme which for the next 3 years holds very good promise. And we are seeing investors interested. And I think it's one of our highest recommendations in terms of where people should invest for the next 3 years.
All right. Great. Chintan, it was lovely having you with us. Thank you so much for joining us today on ET Now, talking to all the unit holders as well, who I'm sure are very pleased with the kind of performance you've delivered in the last few years. Thank you once again for joining us.
Thank you, Murali. Thank you.
Well, we'll take a very short break right here on the show. When we return, we'll be back with our Spend with TMS segment. Don't go anywhere.